welcome to the Tax Roundup for June, and what a busy period it's been. We've already seen some of the enabling legislation for those budget announcements be entered into Parliament. Among them is the Medicare levy increase and also the change in the time period for accelerated depreciation for small business entities. This month, Michael is going to take you through the legislation looking at the small business entity threshold increase and also the company tax rate change and some of the issues that are emerging out of that legislation that are actually confusing people. Rae's going to take you through a new PCG, which looks at a very similar issue with what happens for companies who are franking dividends at 30%, but now they're subject to a 27.5% tax rate. Then we're going to take a look at a case that looks at a government grant that is on revenue account and what the distinction is there. But first up, we're going to go across to Brad from BMT, who's going to take you through those depreciation changes announced in the budget and what they mean now and potentially in the future. Across to you, Brad.
You may have noticed in the budget some changes around depreciation for residential property investors. Let's have a look at these changes and how they may impact on yourself and your clients. Firstly, anyone who's purchased a property or entered into a contract to purchase a property prior to budget night, there is no change. Depreciation was as it was then into the future. Also, from what we can see so far, anyone who buys a brand new property from the budget night onwards, there should be no change to them as well. So they get to claim the deductions just like they did in the past. If you own a property and then you add an item to that property, buy a new stove, carpet or something, you spend some money on that item, you get to make a depreciation claim for that item just like you did before the budget. Where they are proposing to change at this stage is anyone who buys a property or enters into a contract from budget night to buy a property can't claim a deduction for the plant and equipment because they're a subsequent purchaser of that plant and equipment. So that means that older properties will have a bit less depreciation. The building allowance still stays exactly as it was, which before the budget, 2.5% of the construction cost, historical cost. After the budget, exactly the same thing happens. What they're calling is saying this is an integrity measure where plant and equipment sometimes gets a value raised against it when it may have already been claimed before and then claimed again basically. So they want to tidy up what probably is a gap in legislation where that integrity measure, they're calling that. Where they're going a little bit further than this is they're looking at any item that's second-hand in a residential property. So if you buy a property and it's only 6 months old, there's still some life left in those items. They're looking to say that you can't claim any deduction against that as well. We're still trying to get some clarification on the final bits of this legislation because they've still got to write the back end to make sure that we can help them to put something in that's right about the way depreciation is done on these plant and equipment items. So as soon as we get some further information, we'll be sure to update.
Now, obviously, it's more important than ever to make sure that you choose a provider for depreciation schedules that is up to date with the law and where it sits right now so that your clients' claims are not denied by the ATO down the track. So if you need a depreciation schedule done, and you probably should have one done for property investment clients coming up, then give BMT a call. But now across to Mike, who's going to take you through those SBE threshold changes and the company tax changes. Across to you, Mike.
Now, the bill containing changes to the rules that will govern the way SBEs are taxed has finally passed through Parliament and is now law, and the great news is that it applies to the current income year, the 2017 income year. Now, there has been some confusion around various aspects of that bill, what it really means for clients, so let's just spend a little bit of time running through the different components of the bill and what it actually means in practice. First thing that changes is the turnover threshold for small business entities for the 2017 year onwards has been increased to $10 million. The two main exceptions to that are for the small business tax offset rules, where the threshold is $5 million, and the existing small business CGT concession rules, where we still have a $2 million turnover threshold or a $6 million net asset value test. But for all other small business entity concessions, we are now using a $10 million turnover threshold. Second thing that happens is the corporate tax rate changes. So for companies with a aggregated turnover of less than $10 million for the 2017 year, their corporate rate will be reduced to 27.5%. That has a flow-on impact to the way that the imputation and franking system works. For 2016 income year, many of you would remember that even though the corporate tax rate for SBEs was 28.5%, those companies could still attach franking credits up to 30%. That all changes from the 2017 income year onwards. Companies that qualify for the lower corporate tax rate will, in many cases, be restricted in the franking credits they're able to attach to their dividends. And for those companies that fall in that less than $10 million aggregated turnover bracket, the franking rate will be basically capped at a 27.5% rate. Now, the way those rules work is a little bit odd and will take a little bit of getting used to. What those rules say is that your maximum franking credit rate for the current year is based on what the company's tax rate would be this year if it had the same turnover that it had last year. And the reason for that is that you may well have companies paying dividends throughout the income year or even at the end of the year before you know what the current turnover actually is for that year, which is why we're using prior year turnover. What would the company's tax rate be this year if its turnover this year was the same as it was last year? That then determines the maximum franking credit rate on dividends paid for that year. So another change of the way that we'll need to look at the way we deal with companies and dividends. The small business tax offset, I mentioned already the turnover threshold is increased to $5 million. The tax offset rate has also been increased to 8%. Just be aware though that the maximum offset still is capped at $1,000 per year per individual. So there's no change to the maximum offset, but an increase in the number of people who can qualify and the rate at which that offset can accumulate. Now, what all these changes have meant is that a much bigger deal is made of the issue of whether a company is carrying on a business or not. Now, in the past, that still mattered, but nowhere near as much as what it does now. And we're fielding many questions around the issue of, well, is the company actually carrying on a business? What about companies that just carry on passive investment activities, companies that just hold rental properties, companies that might just receive distributions from related trusts, for example, and then use those funds to earn income? Is that a business? Now, if we were to look at the general indicators of a business, in many cases the answer would probably be no. But there are some forms of ATO guidance that suggest that the threshold for carrying on a business is lower when it comes to a company compared to, say, an individual taxpayer. IT 2423, it's been around for a while now. It looks at rental activities and whether they would amount to a business or not. And in that older ruling, the ATO says that generally rental activities carried on by a company can be classified as a business, even though they might not normally be classified as a business if an individual was carrying on those same activities. More recently, the ATO has released a draft ruling, TR 2017/D2, looking at the issue of central management control for foreign resident companies. Now, the ruling doesn't go into detail around what is a business, because that is also relevant to that issue covered in the ruling, but there's a footnote which again provides some general comments suggesting that the threshold for what is a business in the context of a company is lower than it would be for an individual taxpayer. Now, unfortunately, there's still a fair bit of confusion about, well, where exactly is that threshold and what does that mean when dealing with tax implications for companies and also for their shareholders, because it impacts on the franking rate that would apply. We understand that the ATO has actually formed an internal working group to have a look at this issue and hopefully to provide some clarification to us as we kind of work our way through this new regime. In the meantime, if you believe that based on the ATO's comments that companies are carrying on a business and you intend to lodge returns and frank dividends on that basis, it would be a good idea just to keep a copy of those comments that are provided by the ATO and those existing rulings to support the position that's been taken. We'll then let you know if the ATO does provide a little bit more clarity around that issue going forward, so we'd have a better idea exactly where those companies sit in the context of those new rules.
Now across to Rae on that practice companion guide that's been released on overfranking dividends. Across to you, Rae.
We now have the new law where the SBE turnover is at 10 million, which is great news for everyone. However, what happens to those companies that paid a dividend early in the 2017 year thinking they could frank to 30%? That was the law at the time, it's not the law now. They're stuck with having to frank to a maximum of 27.5%. So the ATO, which would normally say, overfranking issue must be dealt with, have come out with some practical guidance in PCGD 2017 D7. What this says is that if there is a company that earlier in the year has overfranked because they franked to 30% instead of 27.5% for an SBE company, what they can now do is they can go back to those shareholders, reissue the dividend statements if they've already done so with the lower amount of franking, and therefore they don't have to lose that extra franking credit from their franking account. They would only have the debit of 27.5% in the franking account. For those shareholders who would not be able to take that extra franking credit anyway because they're limited to the maximum of 27.5%, they can now reflect the correct amount of dividends to declare and the correct amount of franking credits to offset. So a practical outcome for taxpayers who didn't have a time machine at the time.
Now Michael's going to take you through that case of the government grant that was taxed on revenue account.
The case we're looking at this month is the Denmark Community Wind Farm and Commissioner case. Now, this was a case that looked at a government grant paid to an entity relating to a wind farm project that was undertaken. Now, the background to this was this organisation qualified for a government grant in relation to renewable energy programs that were being undertaken. The taxpayer received the government grant, lodged a private ruling application with the ATO, asking basically to confirm that it wasn't ordinary income and that it shouldn't be taxed on revenue account under the rules dealing with bounties and subsidies. The ATO came back and said they agreed that the grant was not ordinary income and shouldn't be taxed under the bounty and subsidy rules. However, the ATO said that the grant should be taxed under the assessable recoupment rules, which would bring it into account basically on revenue account. Now, the taxpayer lodged the tax return on that basis, but then objected to the assessment, and we ended up with this argument over whether this government grant should be taxed effectively on revenue account under the assessable recoupment rules. Now, the court looked at a few different arguments that were raised by the parties in this case. First thing was that just because the payment may have been capital in nature when received by the taxpayer, that didn't of itself stop the payment from being taxed on revenue account under the assessable recoupment rules. So capital receipt can still potentially be treated as being taxed on revenue account if it falls within the scope of those provisions. The next thing that the court had to look at was this government grant a payment received by way of indemnity? Because when payments are received to recoup expenditure by way of insurance or indemnity, it's much easier for those payments to be captured under the assessable recoupment rules. Now, the taxpayer argued that there was no indemnity deed, there wasn't a contract of indemnity, so it shouldn't be classified as a payment by way of indemnity. The court said, well, we actually need to look at this more broadly. The concept of indemnity should be given a wide meaning. And because of that, the court actually said that this payment, even though it was made under a government grant program, was made by way of indemnity because it reimbursed or recouped expenditure that had been incurred by the taxpayer. The next step was to determine whether the recoupment related to deductible expenses. And the taxpayer said, well, we didn't actually claim a deduction for the outgoing, but the court said, well, you're able to claim depreciation deductions. And even though you didn't claim a direct deduction for the outgoing, you were able to claim deductions that related to those outgoings, albeit over a period of time under the depreciation system. So the court said that because of those factors, that this payment should be brought to account under the assessable recoupment rules, effectively on revenue account. Now, the way it works in this case, when you incur expenditure that you then claim depreciation deductions for, the assessable recoupment rules try and match the income with the deductions that are being claimed. So you don't necessarily get hit up front and taxed on the full amount in the year of receipt. It tends to be spread out over the period over which you're able to claim those deductions for the expenditure that has been recouped. So a couple of points that were clarified in the case here, which could be useful, I guess, in looking at situations like this in other scenarios. The very broad meaning of that term indemnity, which could then capture things that we might not normally consider to relate to an indemnity. And also the fact that just because something might look like it might be on capital account, that doesn't stop these particular provisions taxing that on a revenue account basis in an indirect way.
And that's the tax roundup for this month. Remember, follow our Twitter feed and we will keep you up to date on legislation as it is introduced and passes through Parliament that is relevant to the profession and to your clients. But for members, the budget tracker on the member-only website will give you a summary of all the key areas and where that legislation is up to at any one point in time. But there is a huge amount of change coming through. If you don't want to keep your practice up to date and update all your standards, working papers, client letters, tax advice letters yourself, then give us a call on 1800 800 232 and Julie will show you exactly what Knowledge Shop membership can do for you. We look forward to speaking to you soon.